As we welcome a new year, we remain excited about the opportunity set within securitized products, as the asset class remains attractive when compared against other fixed income instruments. 2024 was marked by strong excess returns, as robust investor demand outweighed heavy new issue supply, against a backdrop of strong credit fundamentals and supported macro tailwinds. With spreads hovering near historic tights and credit curves flat, we approach 2025 with a bias towards investments at or near the top of the capital structure, as we opportunistically and selectively seek to deploy capital down in credit. Given the backdrop and the overall absolute level of spreads, we expect spreads to remain range-bound and expect carry to be the dominant driver of excess returns this year. Turning to our outlook across subsectors. In CMBS, CRE values have been adjusting to the higher rate environment, and various CRE price indices were beginning to stabilize in the second half of 2024. In 2025, we anticipate flat appreciation across property types and transaction volume to pick up with greater clarity around valuations. We find value within 5-year conduit AAA securities for their pickup over similar tenor IG corporates, and continue to selectively add exposure down the stack in single access, single borrower securities. In RMBS, while higher mortgage rates have weighed on affordability and demand, the supply of existing homes for sale remains below the long-term average, which is supportive of home prices. We remain bullish on mortgage credit instruments such as second liens and whole loans, while acknowledging stretched valuations across certain segments such as CRT. In ABS, higher food and rent prices have put pressure on lower-income consumer cohorts and has manifested itself in weaker performance across specific issuers and vintages. We expect issuer and subsector dispersion to remain and find value across the prime auto SRT, subprime auto, and unsecured consumer segments, which offer attractive carry for short-duration securities. Lastly, in CLOs, senior tranches continue to offer attractive relative value despite tighter spreads. We remain cognizant of potential credit risk in the underlying bank loans, which could outweigh prevailing technical support for CLOs. Broadly, we continue to favor senior CLO tranches in the US and in Europe, and are selectively adding in new issue mezzanine tranches where we see additional carry opportunities. In summary, despite tighter spreads, we continue to find value across all securitized product segments. A focus on risk-adjusted relative value and a disciplined investment approach will be key to generating alpha in 2025.